right, what's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. We're going to have some fun today talking about whether or not cash value whole life insurance is a good inflation hedge or not. And I wanted to do this video because I just had a really interesting conversation in the comment section of one of my videos, where which I always appreciate, guys. I love when we have an open dialogue and a good conversation going back and forth, even if we don't agree on everything, which I definitely did not. The gentleman I was having the conversation with, the back and forth, we definitely did not agree on most things. We did agree in the end that at the end of the day, you know, that it comes down to individual personal goals, risk profile, things like that. But he was saying that whole life insurance is a terrible inflation hedge, which I would absolutely disagree with. I think it's an incredible inflation hedge, and we're going to talk about some very specific reasons why that is. We're going to talk about how I'm using my policies right now to keep up with and actually beat inflation, utilizing my policy. So we're going to talk about all that. And but really quick before we get started, doing something a little bit new on the channel now. I just got to give a quick shout out to the sponsor of this video, which is me. My other company, Reduce My FICA, where we help business owners with at least 10 full-time W-2 employees significantly reduce their annual payroll taxes, adding $10,000, $50,000, sometimes $100,000 or more every single year back to your bottom line. Like, what would that do for your business? All while significantly also improving employee recruitment and retention. We're offering these pre-tax health and wellness plans. It gives really, really good benefits to your employees at zero net cost to them. In fact, a lot of times they see a net increase in every single paycheck, which is pretty sweet. Not to mention, though, all of the other amazing health and wellness benefits that they get with the program. So if that's something that you're interested, you want to learn a little bit more, you can save on average, businesses typically save on average $300 to $500 per year per W-2 employee. So you have 10 employees, 50 employees, 1,000 employees. Think about how much that can add to your bottom line. All right. So if you want to learn more about that, I'll link that down in the description. With that said, let's dive into some specific points here about why I think cash value whole life insurance is actually a really good inflation hedge. So I think part of the problem part of the problem is when people say that cash value whole life insurance is a terrible inflation hedge, they're only thinking about rate of return, and they compare it to the stock market, which you can't do that. You're comparing apples and tater tots at that point. Cash value whole life insurance is a very efficient savings vehicle, not an investment. Okay. With that said, only talking about the rate of return, it completely ignores all of the other amazing benefits that we get from these policies. But let's just talk about the rate of return. So when you properly design a whole life policy, you structure it for high cash value using paid up additions, lowering the base premium, etc. You increase the efficiency of that policy. So for example, my first policy nets around 4%, give or take. And that's tax-free, which we'll talk about that in a second. But if we just talk about the rate of return, if I'm earning 4% in a very efficient savings vehicle, well, I'm keeping up with inflation just with that. So what are you talking about? It's a bad inflation hedge. All right. But now when we start talking about all the other benefits, like the tax advantages, for example, how much is that adding to your bottom line? Again, like what I was just talking about with the health and wellness plan, right? Adding that back to your bottom line, that you have to add at least another 1 or 2 percentage points to the rate of return, depending on your tax brackets, because you're getting all of these tax advantages. The cash value in your policy grows tax deferred, and you can access it tax free when you set it up right. Use it right. You know, make sure you don't mech the policy, things like that. You know, it's easy to get away to get around all that stuff and avoid it. But you're saving a significant amount of money on taxes as well. Does that happen in a savings account? Does that happen in the stock market? Now, I'm not saying savings accounts and the stock market is bad, but again, like when you start comparing it to these other vehicles, it just doesn't really make sense. And especially when you're ignoring all of the other benefits and you're only talking about the rate of return. All right. So we've got these policies typically net 3 to 5% tax-free. Compound growth. That's another thing too. The money, the cash value in the policy is compounding versus a savings account, for example. You have to pay taxes on that every single year. Also, when you withdraw the money and use it for an emergency fund, like this gentleman was talking about when he was talking about like the savings account and stuff. When you withdraw that money, is that money earning interest for you anymore? Is it compounding anymore? No, it's not. Like you take $10,000 out of your savings account or emergency fund or whatever, that money's not earning interest anymore. That money's gone forever, whatever you spent it on, right? Versus using a cash value whole life insurance policy as an emergency fund. I can borrow against my policy, use the money for whatever it is that I need to cover, whatever the emergency is. But the money I borrowed is still getting that compound interest in the that compound, uninterrupted compound growth, tax-free in the policy. Now, granted, I do pay a little bit of simple interest for that, but I've already run the numbers on this, guys. I've done plenty of videos on why it absolutely makes sense to pay a little bit of simple interest to get that uninterrupted compound growth in the policy, plus all the other benefits. So I'll link to that video down below, because that's another attacking a point or argument that people will make, that who are not fans of whole life insurance. Well, you're paying interest to borrow your own money, which you're not. It's the life insurance company's money. But when you actually run the math, it really does make sense to do that. And it's very similar to what banks do, and banks make a ridiculous amount of money every single year. All right, so let's see. I just got a couple of bullet points here. So we talked about the rate of return, the tax-free, or the tax advantages. Here's the other thing too, is we don't set these policies up to build a massive amount of wealth like with just the policy. Now, with that said, you'd be amazed at what uninterrupted tax-free compound growth can turn into, like what the value of that is, like what your money can grow into over the course of 30, 40, 50 years, depending on when you set it up. I mean, it's a pretty astonishing number. All right. But that aside, all right, we also, like, we're not setting up the policy to get rich, right? We're setting up, at least for me anyways, I set up the policy because I want control of capital. I want to put my money in the most efficient vehicle possible, and I want to use my policy to build wealth. All right. So when he was talking about doing investments and stuff like that, it's like, well, why not put the money in the policy first, borrow against it, and then go build wealth like you normally would? Yes, you pay a little bit of simple interest, but that's, again, another rabbit hole. I've already run the math on that. It absolutely makes sense to do that. Banks do it every day. They pay us 1%, 2%, whatever it is in the savings account. Right now, it's a little bit higher, but historically speaking, savings accounts don't pay very much. But so they pay that to us to encourage us to make deposits, all right? And then they lend it out at 5%. So they pay us 1%. They lend it out at 5%. They make 500% rate of return, whatever. All right. Do you think they're complaining about the 1% that they pay us? No, they're just looking at all of the crazy amount of money they're making, the crazy rates of return that they're earning, right? And they're keeping that money in motion. They're lending it out. They're making other investments, et cetera. So why not do the same thing that the banks do, which is what we can do with these policies? So, for example, right now, I'm about to lend on my very first real estate deal. I started going down the journey of becoming a private money lender. It's just something that really is in alignment with my risk profile and what I want to do to build wealth, et cetera. And we're about to close on that. So I borrowed from my policy. I'm going to lend that out on a real estate deal, literally just like the bank does. I'm going to pay a little bit of simple interest. So my current policy loan rate is 5.5% right now, but I'm going to lend the money out at 12% while I'm still getting the uninterrupted tax-free compound growth in the policy. And the only cost of doing that is the interest that I pay. But I'm essentially making money twice. My policy, the cash value of my policy is growing, and I'm making money with the private money deal as well. Like, what about that does not make sense? It's literally exactly what the banks do, and the banks make crazy amounts of money. And the other, like, when people make the comparison of like stock market returns, you're saying the average rate of return over the last 30 years for the S&P was 11%, which average rate of return, in my opinion, is very, very misleading. That does not mean you're going to get, or your account is going to grow by 11% every single year. Again, I've done numbers on that before as well. But also, you don't have any control of that money when you have it invested. Now, again, I'm not saying not to invest in the stock market. If that's what you want to do, that makes sense for you, go do it. I don't care. But for me, it doesn't make sense, at least with a significant portion of my money anyways, because I want control of it. See, when you dump money into a 401k, IRA, S&P index fund, whatever, that money is locked up in that investment. You have to let it ride for it. Like, if you want to get that 11% average rate of return, even though I don't like net, you're probably not going to do that, but whatever. All right. But in order to get that, you have to leave the money alone. You can't touch it. And for some people that might be okay. Right. For me, it's not. I want to keep my money in motion. Right. I want to actively build wealth with it. I want to lend out at 12%. 2-3 times a year, whatever, right? While I'm still getting that uninterrupted compound growth. So my point is, I'm using the policy to build wealth like I normally would, that far outpaces inflation. So let's assume inflation, let's say call it 3.5% right now, or like 3.3%. Obviously, it's a lot higher than that. I don't think they disclose all of the correct information to us, but whatever. Let's say it's 3.5% and my policy is earning 4%, and now I'm also making 12% over here minus interest costs. Like, what about that doesn't make sense? Not to mention that because it's compounding, the cash value is compounding, it's going to get more and more. That scenario is going to get more and more efficient every single year, because the growth of the policy, like how much my policy grows by, is going to significantly increase, which again is going to far outpace the interest cost, the policy, the simple interest to use the policy, or the cash value to build wealth, keeping up with inflation as well. Like, I don't see how you can say you're not keeping up with inflation in this type of scenario, because I'm getting the 4% tax-free compound growth in policy, earning the 12% on the real estate deal. How's that not keeping up with inflation, right? So it comes down to how you utilize the policy as well, guys. And then the last thing that I want to talk about too, again, I think this is just overlooked, is eliminating all of the massive lost opportunity costs in our lives, guys. Again, I've done plenty of videos on this. I think a really good example of this is when I purchased my vehicle. So I funded my policy first, borrowed against it to purchase my vehicle, to pay cash for it then. But I put the money in the policy first because the $28,000 I used to pay for my vehicle, all right, is still getting the uninterrupted tax-free compound growth. And when you look at the lost opportunity cost, if I had just paid cash, that money's gone forever. It's never earning me another dollar of interest ever again. When you look at the cost of that over the next 30, 40, 50 years, that vehicle, that $28,000 purchase at 4% compounded, would have cost me $134,000. So I essentially put over $100,000 more back into my pocket over 40, 50 years, whatever. And if you do that multiple times with large capital purchases, I mean, most of us buy multiple vehicles throughout our lives. We make large capital purchases all the time, multiple times throughout our life. So like, how many times do we do that? And it puts all this money back into our pocket, which absolutely helps with inflation. For me, that's a rate of return in and of itself, right? How do you put a price on that? Like how much money you save over the long run by utilizing a policy like this in this particular way. So we have, the rate of return, which it's not sexy. We don't set the policies up for rate of return. It's just a savings vehicle, guys. It's not an investment. It's a very efficient savings vehicle. But I think if there was a savings vehicle that was going to pay you 3 to 5% tax-free compound growth for the rest of your life, you'd have access to the money to build wealth with it without interrupting that compounding process. Plus, you have the living benefits, the death benefit in case something happens to you. Like, you're solving all these problems with one vehicle. Like, how on earth does that not make sense, right? Look, it's not for everybody. I get it. But, we've got the rate of return that does at least keep up with inflation when you set it up right. You have the tax advantages, you have the financial efficiency, you have the different ways that you can build wealth with it. So, like, go out and build wealth like you normally would. All right. You're getting all of these additional benefits instead of locking it up in a retirement account or something like that. It's not financial advice. Everybody's different. Okay. Everybody's goals are different. Everybody's, risk profile is different, right? You got to do what's best for you. But I'm saying if we look at cash value whole life insurance and ask the question, does it keep up with inflation? Is it a good inflation hedge? Well, it depends on what you're looking at. If you only stop at the interest rate, then there's an argument. I'm like, my policy earns 3 to 5% every single year, like over the course of the policy, and it keeps up with inflation at least. But we're not even talking, like, when you don't even bring up all the other benefits, though, we're missing a huge part of the conversation. And it's important that you understand this, so again, that you can make the best decision for you. So anyways, just a few thoughts on why I believe cash value whole life insurance is a very good inflation hedge. But that's just me. If you disagree, drop some comments down below and let's have a conversation about it. And if you ever want to hop on the channel, and discuss these things with me. I am an open book. You just let me know when you want to set it up. I love talking about this stuff. Even if we don't even if we don't agree, then that's totally cool. Let me know what you disagree about, and let's have a conversation about it. Right. So either way, guys, I hope you are crushing it. Hope this was helpful, and I will talk to you in the next one. To your success, Matty Ice is out.